Okay, next reading in this topic is investment manager selection. So this is again a very theoretical reading, so we will quickly go through it. And most of what you see in this reading is again what we have discussed in previous levels already. Starting with manager selection process. So when you start the manager selection process, that is when you are selecting a portfolio manager, first thing that you do is that you conduct a due diligence to find out that whether that portfolio manager will be appropriate for your portfolio or not. Now in that due diligence process, what do? You find out that you look at the overall universe of the portfolio managers and you find out who all portfolio managers are available, what kind of styles and approaches of investment management are being offered by them, who are offering active management approaches, who are offering passive management approaches, and what is most consistent with your goals, needs, and IPS. So now when you are analyzing the portfolio managers for their performances, to select them, you should perform both the quantitative analysis as well as qualitative analysis. Quantitative analysis is focused on finding out their historical performance. How have they performed in the past and how has their returns and risk distribution been? Have they performed, have they posted good performance or have they performed badly? And in that you look at the capture ratio, drawdowns and all that, which we'll discuss later as well. Then qualitative analysis. How sure could you be? Then you find out that how sure could you be that this portfolio manager will continue to offer same returns in future as well. So for that you need to find out whether the good returns being made by the portfolio manager in the past was actually a result of taking excessive risk or luck, or is it due to skill, and how sustainable those returns could be. And you also analyze that what is the philosophy of the portfolio manager. Does he follow the active management philosophy or passive management philosophy? How do he or she invest, and what all factors does impact his or her decision in investment management. Also, when you are selecting a portfolio manager, it is good to perform a hypothesis, and the null hypothesis is that there is no value added. That is performing a null hypothesis whether that there will be no value added, and then testing it whether the portfolio manager will be able to add value or not, because you will select if he or she is able to add value, otherwise you will not. But then again, when you run this hypothesis, there are also chances of type 1 and type 2 errors. Type 1 error is that you end up rejecting this hypothesis while this should not have been rejected. For example, you reject that there is no value added, means that you believe that there will be value added, while in reality the portfolio manager does not have a skill to add value. That is type 1 error. And type 2 error is opposite of that. That is you believe that there is no value added. That is, you accept this hypothesis, you do not reject it. You believe that there is no value added, while in reality portfolio manager have the skill to add value. So there could be a possibility of type 1 and type 2 errors, which you need to be cognizant of. And so you should try to prevent any type 2 errors. How? By looking at the past performance, by finding out whether your decisions which you have taken to hire a portfolio manager has been correct or not, and continuously evaluating your decisions and the performance of portfolio managers, and finding out whether portfolio manager have the right skill or not. Did you make the right choice or not? Cost of type 1 and type 2 errors, which we have already discussed, that type 1 error can lead to you hiring someone who does not have the skill, and type 2 error can lead to you not hiring someone who actually have the skill. Then approaches to manager analysis. How do you analyze manager or their approaches? There could be style analysis. Style analysis means that finding out whether the manager is a value investment manager, or he or she is a growth based investment manager, what is his area of expertise, what is his style of investment management and portfolio management, and then you should find out whether that style or that industry expertise or that particular investment management technique used by the investment manager, does it align with your IPS and needs or not. Because you have to hire an investment manager who offers the skill set which is aligned with your investment management needs and requirements and goals. So that is about style analysis. In order to analyze style, whether it is growth, value growth, or whatever it is, in order to analyze that, you can either perform return based style analysis, RBSA, or holding based style analysis, HBSA. Return based style analysis means that you run the or regress the returns of the portfolio being managed by investment manager, and you'll find and you regress those returns over a period of time, and you find out the correlation of those returns with the value stocks and growth stock, and you find out whether those returns follow the same style as value or growth or value growth stocks, to assess what is the actually style being used. And HPSA means that you find out what all are the holdings. You find out whether those holdings in the portfolio, whether those holdings being managed by the portfolio manager, are those holdings value assets or growth assets or a combination of two. So using these two methods you can assess the style of the portfolio manager. Moving on to analyzing the performance further through capture ratios. So capture ratios could be calculated using two ways: upside capture and downside capture ratio. Upside capture ratio, you find out that with respect to the benchmark return, that whenever benchmark gives a positive return, how much extra return does portfolio manager generate. So upside capture ratio will tell you if a benchmark is making return or giving positive return, how good would portfolio manager's return be in comparison to that. And downside capture ratio tells you that if benchmark is going down or giving a negative return, then what will be the performance, what is the performance in that scenario by the investment manager, how much down does investment manager is. So upside ratio, higher the better, downside ratio, lower the better. And then you can take the ratio of these two, that is upside capture ratio divided by downside capture ratio, and the ratio of these two is known as capture ratio. If this capture ratio is greater than 1, that means you have a positive asymmetry, more returns towards outperformance, and less than 1 means negative asymmetry. So this, again, through this you can find out whether how does the portfolio manager perform with respect to the benchmark. Drawdowns are the maximum loss which have happened through peak to trough. So the peak, the largest peak which the maximum draw, the largest peak which fund had hit, and then the lowest trough which fund have hit. The difference between those two is the maximum drawdown or maximum loss which have happened. So again, worth looking at it in order to assess that what have been the possible maximum drawdowns with that investment manager. Moving on, evaluating managers. So you need to, when evaluating managers, you need to evaluate their investment philosophy, whether they are believer of active management or passive management, what risk exposures do they usually take, do they believe in actively finding out undervalued and overvalued securities, or do they believe in taking the risk exposures to risk factors such as equity risk, credit risk, liquidity risk to make return. Again, for those who are for those managers which take passive strategies and which take risk exposures to credit risk, liquidity risk, equity risk, and all these, you should be able to find out that what is the overall systematic risk environment looking like and how much returns could be expected from these investment managers in these times. On the other hand, if an investment manager is taking an active approach, is an active manager, then you need to find out that whether mispricings actually exist in the market or not. Because if mispricings do not exist, then active manager will not be able to make higher return. And even with those mispricing, you need to find out whether those mispricing are due to behavioral inefficiencies or structural inefficiencies. Because if the mispricing in the market are due to behavioral inefficiency, then if a portfolio manager is able to observe it and find that out and quickly act on it, then he or she will be able to make a higher return for you on that. But if it is due to structural inefficiency, then it could take a long, that is for example due to regulations or legal laws or anything, then that could take a longer time to be recovered, or for that to give you a return. So you should analyze investment policy, whether it is a philosophy of the investment manager, whether is it passive or active, and which one is better in the environment which you are operating in. An investment decision making process, that how does he generate idea? Is your investment manager able to generate good ideas or not? How good he or she is with respect to idea implementation? And then portfolio construction, does he have the knowledge of all the assets available, derivatives and all that, through which he could construct the portfolio easily or not? And then portfolio monitoring, that is that the portfolio manager is able to assess any external factors or exogenous shocks or anything, and able to adjust the portfolio with respect to that or not. So this is it. This is about analyzing or assessing manager's performance. Then manager contracts and fees. So starting with liquidity, generally private equity funds have lower liquidity, and generally ETFs and closed-end funds have higher liquidity because they can be traded at any time. Management with respect to fees, investment managers could charge a management fee, that is a specific percentage of the assets under management. For example, 2% of assets under management. They could also charge, in addition to management fee, they could also charge incentive fee. So there could be multiple types of fee structures. 3 basic types of fee structures are symmetrical structure, in which a base fee is charged, that is a fee on the overall base of the assets, plus performance sharing, that is if investment manager makes excess profits, or if an investment manager makes some gains or profits for you, then he or she takes a share of that. Another structure could be bonus with full upside and limited downside, that is investment manager takes greater of either percentage of base, second, or base plus sharing of positive performance. This means that if investment manager performs positively or makes returns for you, he or she gets a higher fee. If he or she makes a loss for you, then still he or she gets a fixed percentage of the base. And then bonus for limited upside and downside exposures, in which a fee greater of 1 base or 2 base plus sharing of positive performance, but within a certain limit is paid. Difference between second and third structure is that in third structure there is a limit placed on the positive performance, which is shared with the investment manager. So these could be the 3 broad structures, and they are like kind of call options, or give similar payoff to the investment managers like call options, in which, for example, base or of your assets or the base fee is your strike. If your assets value go beyond base or above base, then investment manager starts making some extra money due to positive performance, due to getting extra return from performance. Otherwise he or she gets just the fees on base. Similarly, the third option was that again portfolio manager gets a base fee, and then if he or she makes a positive return or gives you a good performance, then takes a share of that, and as he performs better, the share will go up and the fee that portfolio manager will charge will go up, but there will be certain upper limit after which it will become constant. So these are payoff diagrams. These are some basic fee structures which you can go through. So this is it about the reading, fairly simple. Do all the questions from curriculum and Shweta.